Good evening, everybody, and welcome once again to another edition of the Equity Monthly Market Insight webinar. We've been hosting these for almost 2 years now, and we enjoy bringing this monthly webinar to you because it keeps us on our toes in terms of putting together the data and the charts. And every month we also bring on board not just a broad description or a broad discussion about the markets, but every month we also bring one of our fund managers on the call to sort of cover the investment strategy in more detail. And this month, I'm delighted to have with me Ankit Agarwal, who's been leading our mid-cap and small-cap strategy. So he's on this webinar with me today, and he'll be talking about both mid-cap and small-cap investing at UTI Mutual Fund. And of course, as usual, we have my colleague from the product team, Niranjan, who's also here. He's helped put together the deck, and he's also already received a barrage of questions from many of you. And keep sending in those questions because we actually use those questions as a base to sometimes tailor some of the data as well as the slides which go into the presentation. So without any further ado, we'll just get rolling. I'm going to request Niranjan to bring up the presentation on the screen, and I think that's up there on the screen now. So yeah, this is what we're going to be talking about. Well, we are already in the middle of May, so we are coming up to almost the halfway mark of 2023. Time seems to have moved quite rapidly. What's the market done through the first 4 months of the year? You can see that over here on this slide. Over the past 3 months, the mid caps have done the best, followed by the Nifty 50, and small caps have been slightly weaker. If you look at the picture over 1 year, you see a lot more distinction. Again, on a 1 year basis, the Nifty mid caps have done best. But only slightly ahead of the Nifty 50. And actually, the weakest performance has been in the Nifty small cap, which is actually negative over a 1 year period. So, what does this imply for investing based on market cap? Should you think about large cap, mid cap, or small cap? So we'll cover some of this in our slides regarding valuation. And of course, for much more detail about our investment strategy, Ankit will be talking about both the mid cap and the small cap investment strategies, and there are significant similarities between both. But I'll jump on from here to run through our standard deck. This also covers how markets have performed over 1 month, 3 month, and 1 year. Good to see India at the top of the charts there on a 1 month basis, at least within the set of markets that we normally look at. Over a 1 year basis, we are somewhere in the middle of the pack. And very surprisingly, as markets often are, a year ago, we were just in the first flush of worrying about what the impact of the Russia-Ukraine conflict would be on Europe. After all, Europe gets all its gas supplies from Russia, and there were concerns that with the war, this could significantly destabilize things in the European markets and European economies. Now, markets did sell off in response to that, but it's interesting to see that a year later, the best performing markets are actually the European markets, followed by China, which of course got its bounce much later in the year, and India, as I said, sitting somewhere in the middle of that pack. So moving on to the next slide. Here, of course, we talk about the long-term earnings trajectory in India. And while we'll discuss this in a little bit more detail later, what I would essentially suggest that we should look at very closely is the behavior of earnings between March 20, which is pretty much when the pandemic started, to March 23. Of course, we are halfway through the earnings season, and there have been some cuts to earnings. And you can see over there that the March 23 Bloomberg consensus is now only for 2% earnings growth. But this is coming on the back of a record 44% earnings growth, which happened in March 22. But from March 20 to March 23, from 489 rupee EPS for the Nifty in March 20, in a 3-year period, you've seen almost a 80% rise in EPS, to almost a shade under 800. This is a period during which nominal GDP, or rather real GDP, has made very marginal progress, but profits have really ballooned. And we look at what this implies going ahead. But it's been a great year, a great 3-year period for corporate earnings, a lot more muted today, perhaps to do with some of the disruptions which happened once again pursuant to the Russia-Ukraine conflict, which has pressurized margins across many sectors. And the earnings growth expectation for March 24 is now at a 18% earnings growth expectation. It's starting to come down. Sometime back, it was above 20%. Moving on to the next slide. This actually shows you the trend line for forecast for EPS for different financial years. The darkest line in the middle is the earnings forecast for April for the year ended March 23. Now that line ends in March 23, but even as companies are announcing results, the March 23 numbers are seeing cuts, which is why you see that the estimate for March 23 earnings, only about half the companies have reported. It's now closer to 800 rather than the 832 at the beginning of March. The number for March 24, which is the blue line, has more or less been flat over the last, I would say 6 months, which is very unlike the line for 23, which has been seeing consistent declines over the last 6 months. And this sort of unchanged forecast for 23 in the face of what is proving to be a lot more challenging environment in March 23 is what raises concerns about earnings growth estimates, how achievable they are. And we'll be talking about this on some of the later slides. So we've now looked at where are we in terms of longer term earnings trajectory. We've also looked at where are we in terms of current earnings estimates, about 18% earnings growth estimates, as I said, for March 24. What does this convert into when we think about valuations? Now, what we're looking at on this slide is the valuations for the Nifty 50, which is, of course, the 50 largest companies in the country. And we've got on the left-hand side the trailing PE ratio, and on the right side, the forward PE multiple of the Nifty. The yellow line, which you see over there, is the long-term average line. This is an average line looking at data all the way back to 2006. So it's almost 17 years of data being used to plot the average. The red line is one standard deviation above, and typically when valuations are above that line, we would say markets are expensive. The green line is one standard deviation below, and if the markets are below the green line, we would say markets are cheap. In the middle is where we call it fairly valued, because that's where the market spend almost 67% of their time between the red line and green line. That's the statistical definition, and that's where markets are fairly valued. We've obviously now come off the elevated valuations that we had in the last quarter, or maybe the last 2 quarters of 2021, when markets were at record levels in terms of valuations. Markets have effectively gone nowhere now for almost 18 to 20 months. But earnings, as we talked about in the previous slides, have actually moved up. And therefore, as a result, the PE ratios are starting to come down. The forward PE ratio is now closer to 18.3. It's sort of halfway between the long-term average and one standard deviation above. So essentially, PE ratios are in the sort of comfort zone, fairly valued above the long-term average. We can also look at where we are at this point of time in terms of price to book. And on the left-hand side, you see the price to book ratio. On the right-hand side, you see return on equity. These two are, connected to each other, because a higher price to book ratio very often could be a function of a higher return on equity. So take a look at the right-hand side of the chart. Look at that return on equities line. Very recently, it was closer to 15%. It's now at about 14.2%. And just look at that line. This is actually the highest ROEs that we have seen going back almost 7 to 8 years. So these are the best ROEs that we have seen, except for the pre-2013 period. Now, in that context, you look at the left-hand side, and what you see is that the price to book is obviously now trading significantly above the long-term average. Not in expensive territory. It did briefly go into expensive territory last year, but now it's more in the comfort zone above the long-term average, but below the red line, which is where the expensive line occurs. So both on a price to earnings basis as well as a price to book basis, the market is sort of in reasonably valued territory. Not too attractive, but neither is it too expensive. Typically the kind of area in which we would say continue allocating to equity through a staggered manner. It's neither attractive to take money out of markets, neither is it attractive to put in large lump sum investments. But again, we'll talk about that later. Moving on from the Nifty 50, what we are looking at over here, and we are looking only at the price to book over here, we're not looking at price to earnings. Where are we in the cycle as far as the price to book is concerned of the Nifty mid cap and the Nifty small cap? I'd say the picture on the Nifty 50, Nifty mid cap 150 is actually not very dissimilar to the Nifty 50. Somewhere between the yellow line and the red line, suggesting it's in the reasonably fairly valued territory. And this is an area where one can sort of stagger the investments, not yet very attractive from a lump sum perspective. But the right side, which is the Nifty small cap 250, showing a slightly more expensive picture. The small caps have traded expensive now for an extended period of time. About 2 to 3 months ago, they did drop below the red line, but the recent sort of recovery in the markets has pushed valuations above the red line again. So I would say from a valuation perspective, when we look at price to book, our comfort with large caps and mid caps is sort of similar, but just looking at the valuations, small caps really not looking as attractive as the other two. Moving on from looking at these, what we are going to do now is look at how do equities in terms of valuations compare to the attractiveness that of the yields that we can get in the fixed income market. So what are we comparing here? We are actually comparing the earnings yield of the market. Earnings yield of the market is nothing but 100 divided by the forward PE multiple of the market. And we are comparing that number with what you can get in what we would call a risk-free security, a long duration security, which is the 10-year GSEC bond, which, as you would be familiar, is currently trading somewhere about 7,705 on a 10-year bond. Now, when this blue line is above the yellow line, that's when equities become tactically attractive. When the blue line is below the yellow line, then bonds are more attractive. Having said that, in the last 6 months, bonds have, relatively speaking, become less attractive compared to equities. So 6 months ago, we could have argued bonds looking very attractive relative to equities. But as that line has moved up, we are still in territory which is favorable to bonds, but not as attractive as it was, 4 or 5 months ago. So that's the message from comparing the valuations of equities to bonds. The tactical indicator still tilting slightly towards bonds as compared to equities. Jumping from there to the next slide, this is actually a repeat of data I showed you earlier. We previously looked at the price to book multiples of the Nifty and of the Nifty mid cap. Here, what we are doing is we are actually looking at the P multiple of the Nifty vis-a-vis the Nifty mid cap. Now, when you see that green line, that means that the mid caps are at a premium to the large cap. So it's in negative territory, which means that the large caps are at a discount to the mid caps. So in a sense, on PE basis, the equation continues to be favorable towards large caps over mid caps. But when I look at the price to book, I would say we are somewhere in similar territory of valuation, both for mid caps and for large caps. So finally, just to sort of get to my summation slide, which is a wrap up of some of the macro, here are some of the points that we think are crucial that for investors to know. As you're aware, earlier this month, just last week, the US Federal Reserve hiked rates again by 25 basis points to 525. But the bond market, or rather the swap market, is actually pricing in 80 basis points of rate cuts by the US Federal Reserve in December 23, by December 23. Now, this is a bit surprising because even when the Fed hiked rates last week, they indicated that they remain on guard. They said, we are not in a hurry to pivot. Pivot meaning we are not in a hurry to get into rate reduction strategies, simply because inflation is proving to be quite sticky, both headline and particularly the core inflation rates. So there is a bit of a dichotomy here. The Fed is actually saying, okay, I may not press the accelerator harder anymore in terms of rate hikes, but I'm not ready to, take my foot off the pedal at this point of time as yet. But markets are saying, yes, they will take their foot off the pedal, and almost 80 bips of rate cuts being the expectation by, December 23. There's a bit of dichotomy here, and, we'll see who's right, whether it's the markets or whether it's the US Federal Reserve. History suggests that the Federal Reserve follows the market, but as they say, it doesn't always repeat. So we'll have to watch out for how this plays out. Now, whilst inflation might be sticky, the reality is that when we look at global indicators of growth, be it commodity prices, shipping freight rates, and other global economic indicators, most of them are indicating a weak global growth outlook. In fact, last month in April, the IMF came out with its global growth outlook forecast, and they cut their growth rates for both 23 and sort of flatlined the growth expectations for 24. The US market, US economy rather, still demonstrating some kind of resilience, but many of the other economies around the world now starting to display fairly lackluster trends in terms of growth, perhaps a reflection of the hike in rates which have happened over the last 1 year, which have been, unlike any rate hike cycle we have seen in the past. And in fact, in India, the MPC halted its rate hike cycle last month, saying, look, we've already done many rate hikes. We still think the appropriate policy stance is withdrawal of accommodation, but we want to now be on pause. Unlike the US Federal Reserve, they did not hike. And the reason they said we are on pause is that we know from history and data that when interest rates are hiked, there is a time lag between the point of the hike and when its impact filters through the economy. So there are time lags, so to speak. And what the MPC in India said is that we are on pause because we think there is a time lag between our actions and its impact on the economy. And we want to monitor the incoming data. And based on what it looks like, then we will decide what the appropriate policy move would be in the future. So they sort of left their options open, saying we will wait for incoming data. Now, earlier I talked about earnings numbers and said March 23 estimates have been cut slightly. But where are we in terms of the profits of the Nifty companies who have reported as of day before yesterday? 26 out of the Nifty 50 companies had reported results, profits growing at about 10% year on year. So the fact remains, when you look at those previous growth rates, I said 80% growth in profits being forecast between 2020 and 2023. But clearly the year on year growth rate is now starting to moderate. The 18% effective earnings growth rate estimate in FY24, March 24, we think there is some risk to that number. Why? Because the global economy is slowing. India's own sequential growth rates are now stabilizing. They are no longer in acceleration mode. There are some signs that actually there is some weakening happening over there. And B, fiscal policy is a restraint. Remember, India continues to crunch the fiscal deficit in the years ahead. And there is also monetary restraint. While the RBI may not have hiked rates, remember that their effective rate hiking cycle is now in excess of 350 basis points in just a little over a year. And that's a very aggressive rate hike cycle compared to anything we have experienced in the past. So there is some concern that those earnings estimates for 24 might not materialize. Equity valuations are now in the comfort zone, not the way they were expensive in late 2021, far more in the comfort zone. And when we look at the valuations relative to bonds, yes, the needle is continuing to tilt slightly towards bonds. Bonds are a reasonable alternative in the portfolio, as we've said before. But clearly, the attractiveness of bonds has decreased. The 10-year bond yield, which used to be 730, 740, has actually sold off now to about 7%. So for bond investors, that actually generates capital appreciation. And that is why we would say, the bond market is still tactically attractive compared to equities, but not as much as it was 3 months ago. So looking at the valuation indicators for equities and in comparison to bonds, what do we recommend to investors? We think they should continue to adopt a staggered approach towards equities because you're in the fair valuation territory. 67% of the time, valuations stay in the fair value territory, and therefore continue with staggered investments. There is no indicator for you to make either large lump sum investments or withdrawals at this point of time. So that's about the market, economic summary at this point of time that I wanted to share with you. And as always, I'm going to now pause and hand over to my colleague Ankit. As I mentioned earlier, Ankit leads our mid-cap strategy and our small-cap strategy. In fact, he helped launch our small-cap strategy way back in 2021. And I think it was a very useful addition to our overall product offerings and a very well-timed offering at that point of time when valuations were very attractive. Today, that is not so much the case, but I'm not going to steal Ankit's thunder. I'll hand over to him, and he's going to talk about how he manages the strategy and also how he views the opportunity today. Over to you, Ankit.
Thanks, Vetri. Thanks a lot for the introduction. Good afternoon, everyone. I'm here to present. I manage the UTI mid-cap and the small-cap fund. And over the next 15-20 minutes, we're going to understand what's the basic investment approach, thinking behind how we manage both the strategies. So from a very sort of broad perspective, the basic approach that we have is that we are looking at businesses which are scalable in nature. So almost 60 to 70% of my portfolio would be in companies which are high, have a consistent track record of growth, have demonstrated a track record of high return on invested capital. And, that could come by, whether it might be because they have a sort of a brand, very strong brand, or they have some sort of a cost leverage, which they have built over a period of time. And that sort of results in, high returns on invested capital, which then enables them to reinvest that capital into the growth of the business and are able to see that consistent compounding over the years. So what we're trying to build here is a core of high quality businesses run by good managements with high integrity and managements which have sort of a long track record and sort of a vision for growth. A smaller part of the portfolio, around 30% of the portfolio, we also look around for turnaround and transformational opportunities. Turnaround are businesses which are good quality, which are maybe run, are market leaders in the space that they operate in, but they might be going through a temporary phase of downturn. And therefore, if you buy these opportunities when businesses are maybe probably not doing well, and therefore a lot of the supply side gets impacted, a lot of the weaker players sort of go out of business. When the cycle turns, you will not only see the companies gain market share because some of the weaker players are out of the market, but also valuations re-rate. And that could sort of create significant alpha in the portfolio. So what we're looking at over here are businesses where we believe a turnaround can happen. And a smaller part of the portfolio, we are also looking out for what we call transformational opportunities. These are basically businesses which are going through some sort of a transformational change, which could be either in terms of a management, change, which could lead to positive catalysts, which can revive the operating metrics of the business, or it could be that the sector might be going through some sort of a structural change, which could lead to a significant re-rating of the candidates in the portfolio. So this will be sort of a subset of the whole turnaround and transformational opportunities. So therefore, the portfolio at its core focuses on wealth creation by consistent compounding and does this through balance of growth and value opportunities, both in the portfolio. Yeah. So I think when we are looking at stock selection within the mid and small cap space, what I have learned over the years, many years of managing mid and small cap portfolios, is that you need to buy into companies which are market leaders in the space that they operate in, and companies which can potentially become the large caps of tomorrow. And the way that happens is that you don't buy you buy the companies which are actually present in sectors which might be small niche today, but because that sector has an opportunity to grow over a period of time, you not only get the stability of a large cap because you are betting on market leaders, but you also get the growth of a mid cap. So what we call large cap isotopes, right? Companies which are akin to large cap, owing to its leadership, balance sheet strength, and ability to attract capital, but operate in a smaller niche sector and therefore give you growth of a mid cap. So that's one core pillar, what we are looking at. Second, we do focus a lot more on governance, and therefore we do our own qualitative and quantitative checks on the management quality to determine what is the sort of an integrity perspective, how are the managements placed, what has been their track record of performance over the years, and also obviously what is the bandwidth of the management to really take this organization to the next level. So that becomes a second most important pillar when we are looking at evaluating businesses. And thirdly, risk mitigation is very important when it comes to mid and especially when it comes to the small cap space, because we have seen significant return divergence, when it comes to the best performing companies in the small cap space to the worst performing companies. And therefore, as much as having good businesses in your portfolio is important, it is also very important to avoid poor businesses and poor managements in the portfolio. And therefore, our focus is to build our significant chunk of our portfolio in what we call R1 companies, because we have seen that during periods of drawdowns, when you see either the market seeing significant volatility, or when the macro is sort of weak and a lot of your weak players, they sort of exit the business, the market leaders and high quality businesses, they tend to consolidate and in fact gain market share from the weaker, either unorganized peers or even the weaker organized players. So risk mitigation is very important, and that's partly done through focusing on good quality companies, having some amount of style diversification in the portfolio, and also by having a fairly diversified portfolio by which you want to reduce the idiosyncratic risk of owning a company which might impact your portfolio, and also to manage the liquidity risk. Because typically the mid and small cap space, the liquidity is fairly low, and you do not want to be in a situation where your impact cost in the portfolio leads you to see significant damage. So these three become very important pillars when we are evaluating companies in the mid and small cap space. Yeah, so just to sort of deep dive into some of these aspects. So what we are talking about in large, and we have sort of written this in a blog, which is there on our website. What we want to buy, are what we say are large cap isotopes. So by large cap isotopes, we mean, so isotopes are, sort of chemical elements which have the same mass but different, which have the same number of protons but may have different mass, and therefore they have different chemical, they may have similar chemical properties but different physical properties. And what we are trying to understand here is that, why we like large caps in general is because these large caps are market leaders. They have good balance sheets run by great management, and therefore their performance volatility is very low. So you get a lot of stability in terms of performance. What we understand is that there are a lot of companies in the mid and small cap space which are akin to large caps, which by that I mean that they are large companies in a mid and small cap sector, right? And therefore, if you bet on some of these companies, then you are, betting on stable growth, but because it's a mid-cap sector and niche sector, you would also get higher growth in that business. And the way you demonstrate that is, typically these companies will have large or dominant market share in that sector that it operates in. In some cases, you will have global market share in some of the products that you produce. You should demonstrate some amount of pricing power, which means that your margins across a cycle should be a lot more stable and should not be very volatile. Business should be able to generate economies of scale, and therefore some of the manufacturing-led businesses should have significant global scale. Companies should be able to access capital, well-managed balance sheet. Typically, these companies will operate with low amount of leverage, and they'll be able to raise capital from the market very easily. We do tend to see these businesses to gain market share from either weaker players or weaker unorganized players or weaker organized players also. And typically that becomes much larger when you are operating in a weak macro environment. And definitely, you're looking at a good track record of management and integrity. So all that sort of factors contribute into making a company what we call a large cap isotope, which has characteristics like a large cap, but operate in a mid cap sector. Next. And, and the reason that you are able to find some of these companies in the mid and small cap space is because there are a lot of these sectors which are underrepresented in the large caps, right? So for example, when you're looking at big sectors in large caps, so you are dominated by financial services, oil and gas, IT, FMCG. But there are a lot of, companies in the cap goods sector, healthcare, chemicals, consumer durables, which are fairly underrepresented on the large cap space. And that's where you have the opportunities to play in. So mid and small cap segments also give you an opportunity to play some of these sectors which are underrepresented in large caps, and therefore they are leaders in their own right. Next. I think what we are also trying to focus on are good quality businesses. And because these businesses are very high quality, they tend to outperform during periods of drawdown. And the reason why that happens typically is that it's only during, macro downturns when, there is panic around the world. It's actually good quality businesses which tend to hold their fort much better. And therefore, and typically we have seen this in periods of, weak macro, that the stronger players, they tend to take market share away from weaker players. And that's where, if you see historically, the companies which are good quality businesses, they end up outperforming. And here sort of we did this analysis on the small cap universe of the 250 companies that are there within the top 500 companies. Basically, we divided them, we looked at their track record across different time periods. And, as per our investment process, we have divided them into these three buckets: R1, R2, R3. R1 are companies which are 18% plus pre-tax ROCE. R2 is between 10 to 18%, and R3 is less than 10%. And therefore, typically an R1 company is what we sort of will call a high quality business. And if you see the historical track record across different periods, and specifically look at it during the periods when the markets were down, R1 companies significantly tend to outperform versus the R2, R3 companies. And therefore, if you're owning a large part of your portfolio in R1 companies, then you would across a cycle tend to outperform, because during drawdowns, you will hold your portfolio much better. And then when the cycle reverts, even if you participate in an upturn across the cycle, you will end up doing much better. So therefore, our focus is, not only from owning good businesses, but also from a partly risk mitigation perspective. Our strategy is to own good quality companies, as typically sort of tilted towards R1 businesses, so that during drawdowns, if we are able to do well across the cycle or over the long term, we will end up outperforming. So that's the core focus of both the mid And specifically, our focus on high quality businesses in the small cap is even on the higher side. I think, again, if you look at the performance on a 10-year basis, and we looked at this same universe of stocks, how they performed over a 10-year period, we find that the percentage of R1 companies that tend to outperform in the long term, that percentage is very high. When you're looking at R1 companies, and the companies actually which have underperformed over a long periods of time, I think the proportion of R2, R3 companies there is much higher, and R1 is much lower over there. So if you have a portfolio which is more focused, I mean, the empirical evidence suggests that that portfolio ends up doing well across, on the longer term basis. Yeah. I think these are some of the companies that are some case studies as to what we mean by large cap isotopes. So someone like Chola would be almost a leading NBFC in the asset financing space. A PI Industries would be a market leader in the custom synthesis business on the chemical side. Something like a Bharat Forge or Schaeffler would be market leaders in auto and auto component space in their own right. Astral would be a market leader in the CPVC segment, APL Apollo sort of on the structural pipes, and so on and so forth. So a lot of the companies that we hold, you could identify very clearly that these companies are leaders in their respective space, which gives them the ability to benefit from the growth that that sector witnesses. Yeah. Why focus on governance? I think the second bit that we talked about was on governance, and the point that we made on that slide was that the return divergence that we see, and specifically if you see in the small cap and the mid cap space, that return divergence is very high. And this is, we have seen this over long periods of time. And therefore, you need to build a portfolio which can withstand this volatility, which is inherent in the mid and small cap space. So they have wide range of outcomes, and therefore it's not only important to choose the right companies, it's also important, a part of your alpha is also contributed by avoiding wealth destroyers in your portfolio. And this we sort of gets reiterated in some of these companies, which obviously we have not put any names here, but these companies have had institutional holding also, and therefore it's very important. Like I said, eliminating detractors in your portfolio is also very important when we are looking at governance. And a lot of the companies over here would have had some sort of a governance misstep, which has led to a significant wealth destruction. So that's why there is a lot of focus when we are looking at the mid and small cap space to be able to avoid some of these wealth destroyers by looking at balance sheets well, to look at doing a little bit of forensic analysis on the companies, trying to do channel checks to understand what is the feedback on the company, on promoters, what's the quality of the business. So a lot of work goes, on kicking the tires to see how the businesses are built over a period of time to be able to at least avoid some of these companies which may have some sort of an integrity issue and prevent them from reducing our overall return. So a lot of focus therefore is on governance, and then risk management is very important. So not only does it flow from the quality of selection, focusing on high quality businesses, but to basically have various guardrails put in place with respect to what I can hold, as far as I could be positive on a company or a sector, but our internal stock limits, etc., prevent me from being overexposed in one company. And specifically in mid and small cap, you need to be also aware of what sort of liquidity is there in the stock, and therefore you sort of position size your opportunity appropriately to take care of any liquidity issues that you might face. So reduce idiosyncratic risk with respect to the portfolio, with respect to a stock, and also sort of look at position sizing as far as valuations are concerned, and also from a liquidity perspective. Yeah. And just to sort of, look at it, I think if you look at the longer term returns of the indices, what we have observed over a period of time is that, mid caps, they tend to sort of outperform both the small caps and the Nifty 100 over the long term. And so while they do have a relatively higher volatility, but they do tend to compensate for that with higher return in the portfolio. But the way we manage it is focusing a little bit more on quality and governance a lot more, and therefore our focus is that how does the portfolio, and true test of that portfolio is during drawdowns. If you do well during that, automatically in the upturns you will be able to do much better. Yeah, I think over the long term, we have seen even in the mid cap space, the style discipline does play a role over the long term. I think last 1 year has been more sort of focused towards value, has done really well. Our style is still a little bit more concentrated on high quality, although we do have some element of allocation towards value. But our sense is that, but in the long term, your stock selection tends to sort of convert. So if you look at it on a 10-year period, actually both the mid cap quality and the index, they sort of tend to converge. And our sense is that with rates sort of peaking out, you could see and sort of getting into a little bit more tougher macro environment, you would see focus coming back on quality businesses over the medium to long term. Yeah. Great. I think that's all from my side. Just to very summarize this sort of our strategy when it comes to mid and small cap space, large core portfolio, 70% into companies with long runway of growth, 30% more on turnaround transformational opportunities, focus on large cap isotopes, good governance, risk mitigation, and make sure you build a portfolio that does well during drawdowns and across a cycle. Therefore, your portfolio will end up doing much better. Thanks a lot, everyone, for patient hearing. Niranjan, we can take the questions now.
Yes, sure. Thanks, Ankit. Indeed, thanks for a detailed rundown on the our strategies, mid and small cap fund. Yes, now we will move on to take the Q&As. Some of the questions are up on the slide. Here is the first one to you. While the earnings trajectory for IT sector is expected to improve in FY24, where do mid-tier IT companies fit in on account of valuations and optimization of costs?
I think, as far as, so while the near term, medium term, sort of maybe the next quarter or two still looks a little bit of hazy as far as, because what we are seeing in the US banking sector and the regional banks in the US and what impact it could have with respect to investments in technology. What gives us comfort is the commentary of the larger banks have continued to remain quite positive in terms of investment in IT and their focus on doing a lot more digitization specifically, and also a lot of the companies who have started on this journey of cloud migration. I think it'll be very difficult for a lot of them to sort of stop that midway. So I think the longer term drivers are still pretty much intact. But like we see in every cycle, as you see some amount of volatility in the business, businesses tend to sort of do a little bit of wait and watch, and that's what I believe is happening in the near term. But we do remain sort of positive on the good performing mid cap IT companies. I think on a relative basis, if I look at it from a more long-term growth basis or the ability to generate free cash flows and the ROICs that some of these businesses earn, I think the valuations are still fairly decent. And in a scenario where we are seeing interest rates probably sort of peaking out in US, I think the derating that the sector had also seen because of a sharp interest rate move, I think that will sort of come to a halt. So my sense is that maybe the near term might be still a little bit hazy, but I think the key drivers on long-term growth, they remain intact, specifically on the IT space. Yeah.
Okay, great. Yeah, thanks, Ankit, for that. We will take the next question. This is a question to Vetri. In fact, the quality of corporate balance sheets is the best in a decade with strong operating cash generation in recent years. So, is this likely to drive the capex cycle higher? Over to you, Vetri.
Yeah, good question, Niranjan. In fact, we touched upon this in our monthly market commentary in the fact sheet and also in the CIO letter, which is on the website. So I do urge you to read that for a more detailed answer to this. But let me just make 2 points here. We certainly have the best corporate balance sheets in a decade, simply because of the strong surge in profitability that I talked about earlier over the last 3 years. And also, what has happened is that because the banks have significantly cleaned up their books, they've raised capital. We also have banks which are very well positioned to be able to drive a corporate credit cycle. But I think when we think about the capex cycle, we have to pause for a moment, because it is not that our capex cycle is insignificant, right? I mean, we are currently, as an economy, investing somewhere between 26 to 28% of GDP every year. This is not a disappointing number by any stretch of imagination. It is actually a very healthy number. Now, if you compare it to our own past history, yes, there was a period of time in the mid 2000s, somewhere between 2004, maybe all the way up to 2010-12, where there was a period where gross fixed capital formation in the economy was running closer to 35 to 38%, rather than the current 29%. But while that felt wonderful at that point of time, because the economy was growing gangbusters, growth was very strong, everything was fabulous, we also know that just like if you stay on steroids for too long, there are significant side effects which follow. And what did we see after that investment boom, where significant amount of malinvestment happened, was entrepreneurs went bust, companies landed up in IBC, and the banks had to take significant haircuts and losses. So I would argue that what we really need is a sustainable capex cycle rather than a capex cycle on steroids, because there is always a cleanup which follows after that. So in a sense, as investors in businesses, we obviously want companies to reinvest in their core, because, we've talked about this earlier. There is no magic mantra as simple as one in which a company creates operating cash flow, takes that operating cash flow, puts it back into its core business, generates a high return on capital, thereby creates a positive spread and creates value for its shareholders. So capex is in our interest as shareholders for a company to persist. Now, the nature of capex could be different. Some companies do capex in their balance sheet, which is traditional. Many companies do capex in their P&L account, which means it's not treated as capex from an accounting point of view, but these are investments in brands, technology, people, which based on accounting standards are written off rather than being capitalized. So we do want companies to conduct capex, but we want them to be sensible about it. We want it to be sustainable. So we would actually, as investors, prefer if companies were prudent in capital allocation rather than get carried away with the animal spirits of the economy and drive a unsustainable capex cycle. But I'll certainly say this: the necessary ingredients are in place for the capex cycle to perhaps accelerate, with one missing element, which is that when companies look across the world, what they're also seeing is a world which is getting fractured in terms of trading blocks. There are new complications in terms of capital flows, and maybe that to some extent is holding back their determination or their inclination to invest more aggressively. So there is one limiting factor, but the ingredients to lift that rate are there. But as investors, we would look for more prudent capital allocation rather than for investors to demonstrate animal spirits and then have to clean up a mess somewhere down the road.
Sure, Vetri. Thanks a lot. In fact, I also encourage our viewers to go to our website where our CEO writes the commentary on monthly basis, which is the latest commentary is already there, which is live. So for a detailed view on the capex, probably you can go there and read the article. So we will take the next question. This is a question to Ankit. Ankit, financial services appears well placed on account of low NPAs and healthy credit growth. So what is the reason for our strategy to be underweight in this sector?
So I think one thing which I should like to clarify is that both mid and small cap strategies are very bottom up driven strategies where you're looking at individual businesses, evaluating the merits on the long term basis, and if you believe that this business can generate wealth over a period of time, you would buy them in your portfolio. Otherwise, you would not. So therefore, sector weightage is actually an outcome of your bottom up picks. So you do look at top down allocations from a risk management perspective, but when you're building a portfolio, you're looking at companies from a more bottom up perspective. And therefore, our sense is in the long term, a lot of the financial services companies, specifically on the bank side, the market leaders are there on the large cap side, and therefore a lot of these banks, especially, may not have significant moats in their business to really compete with some of their larger peers in the longer term. And therefore, on a structural basis, maybe, some of these banks that are there in the mid-size, whether it, may not make sense to hold from a longer term perspective. And therefore, it's more of a bottom-up call to be underweight some of these opportunities rather than, taking a macro call on the sector as a whole.
Next question to you again. So on account of elevated valuations in mid and small cap segment, so what do you advocate investors who are looking to build exposure in the funds investing predominantly in mid and small cap?
Yeah. No, I think, yes, I mean, probably valuations are not in the most comfortable zone today. And therefore, and that this is a recommendation for anyone who's sort of looking at this space, that one has to look at the mid and small cap space from a longer term perspective, because it's only when you play out a cycle do you see that benefits of compounding over the long term. And anyone who sort of looks at mid and small cap space from a very short term perspective is bound to get disappointed. So my simple suggestion to all investors would be to, when you're looking at the mid and small cap space, have a slightly longer term horizon, because only when you let that whole cycle play out do you see really good quality businesses ability to compound earnings over a period of time. And therefore anyone who's looking at the space even today should be looking at it from a longer term perspective, and someone who's building exposure fresh should be looking at more sort of systematic investment, staggered approach to investing when you're looking at the mid and small cap space today, so that you do get some benefit of valuations, if at all you do see some time correction or price correction in the market with respect to the mid and small caps.
Yeah, sure, Ankit. We will now take more online questions which are coming in our way. So the first question we will take it for. Yeah, this is a question to Vetri. So Vetri, so IMF actually expects the global output growth to fall from 3.5% to like 2.8% in 2023. So before rising it to 3% in 2024. So while worries about high inflation persist, recession concerns have gained prominence. So what's your prognosis of this development, and do you think 2023 will be a year of consolidation?
Sure. So, I would say two things. One is when we look at inflation, it's reasonably clear that a lot of the supply side inflicted inflationary pressure, particularly in the goods economy, is now clearly behind us, right? Because we talked about falling commodity prices, falling freight rates, and some of the other global growth indicators are also pointing in the same direction. I think particularly in the US, there is still a problem in the services side, where their job market remains very, very tight. Therefore, services inflation is very sticky in the US. As far as other geographies are concerned, services are not so sticky. As far as inflation in India is concerned, some part of this relates more to food prices, where we know that the cycles can be slightly different because they're not related to traditional sort of supply demand forces, because the ability of supply to respond is a lot more limited, and there are long lead times. So I would say really at this point of time, the issue is one more of the hike in interest rates transmitting through economies across the world, because the hike in rates that we've seen either by the US Federal Reserve or in Europe or in India, these are unprecedented, right? In a 12-month period, the kind of rate hikes we have seen, if in late October 21 you had told somebody the Fed is going to hike rates by 525 basis points in the next 18 months, they would not have believed you. But that is exactly what has happened. So I think the bigger concern is that this hike in rates can expose fragilities within the system, both in the real economy as well as in the banking system. We have seen some episodes of that, and I think that is why the Fed is also a bit cautious, saying, we think there will be a lagged impact of these rate hikes. So I worry more about eventually the essential growth slowdown than inflation itself. And I think, that is what is behind the IMF's cut in growth forecast. Typically what we say, as long as global growth stays about 2.5%, it's a reasonably healthy outcome. I think from India's perspective, the six handle looks achievable. The question is whether we can actually see an acceleration, and unfortunately, that is not visible at this point of time.
Okay, sure. Vetri. The next question, in fact, this is a question which is coming from many investors and also perhaps MFDs. The question is like this: the funds with investment approach of investing in high quality businesses, something like UTI FlexiCap, have continued to underperform value strategy and even the broader markets over the last 1 to 3 years period. So this is certainly causing worry to investors. So the question is there a light at the end of the tunnel?
There is light at the end of the tunnel. We just don't know where exactly the end of the tunnel itself is. But I'll say this much, right? And we've talked about this. We've put presentations. Once again, there's both a YouTube video as well as a blog that we put out recently with Ajay Tyagi, our head of equity, talking about these cycles. If you haven't seen that, I do request that you take a look at that. But to cut a long story short, it is a cycle. And all cycles come to a natural end, a natural inflection point when things have been carried to an extreme. So I think this will also reverse. I'd say this is already reasonably long in the tooth. If you were to ask me to point to fundamental reasons, look, when rates started to go up from sub-zero, we could argue that long duration assets, and equities by definition are long duration assets, and within that a growth quality strategy is automatically biased towards company with very long growth runways. So that saw the maximum impact of a PED rating, which typical value businesses do not see. But I think we've now reached a point where the cost of capital curve has been meaningfully pushed higher, because you can invest in US bonds, which give you 5 quarter for a very, very short period of time. So cost of capital has moved up significantly. And I do expect with this increase in cost of capital, once again, investors start to worry about what is the spread that my company is able to earn for me in excess of the cost of capital. So I think the needle is once again moving now towards the spread rather than towards the starting point of what is the cost of capital and is it zero. And as that needle shifts, you will start to see once again companies which have high return on capital. I'm not talking about long runway of growth, but I'm talking about companies which have high return on capital should typically tend to come out stronger in an environment where rates remain higher. And as we are looking in both India and US, if the rates do remain higher for longer, because that is what the Fed is saying, that is what RBI is saying, that they're in no hurry to pivot, they're in no hurry to cut, then I do think we are getting closer to an inflection point in that, quality versus value trade.
Thanks, Vetri, for that explanation. As it is already time, in the interest of time, we will take the last maybe 2 or 3 questions. Ankit, this is a question to you. So this is a question on the portfolio churn of the strategies in the mid and small cap. So do you have any framework for self-discipline in our portfolio construction, and what is the portfolio churn expectations? If you can share some insight there.
So, I mean, while we do not work with any specific number in respect to churn, I think the way we work it out is through position sizing. So, for example, if and we have two parts of the portfolio. So you have one sort of more high quality, sort of consistent growth bucket, and then you have the more turnarounds and transformational opportunities. So actually, the more turnarounds and transformational ones will see a lot more profit booking happening as the turnarounds play out, and therefore churn in that part of the portfolio will be much higher. While the one which is more consistent growth, sort of what you're playing for consistent performance over the years. I think the way you manage, valuations, etc., in this part of the portfolio is through doing position sizing. So you could be sort of bullish on the company, and you have maybe a 1% overweight. Maybe with price move it goes to 2% overweight, so you trim that position to a level where you believe you are comfortable holding on to it from a longer term perspective. See, because at the end of the day, if you're holding on to good quality businesses, what we have seen is that over a period of time, most of these, almost 70% plus of these businesses, continue to remain high quality businesses in future, and therefore it makes sense, as long as your long term investment hypothesis remains intact, it it makes sense to hold on to it. But obviously you would do some amount of position resizing to build it, to bring it down to a level where you are more comfortable. Although in cases where you believe that your investment hypothesis is broken, or you see some governance concern, or you do in those cases, you definitely obviously will take a call to exit some of these stocks. So I mean, I think it's a mix of a lot of things. We do not plan for a certain amount of churn, but the 30% of the portfolio turnaround will have slightly higher churn. I would say the more core portfolio will have slightly lower churn. So
Sure, Ankit. So in the similar lines, there is one question from one of the investor. So what's your view on the PSU stocks with high dividend yield, and what are the filters that you typically use before investing in such opportunities, if any? And also your views on the real estate sector, as there is some sort of green shoots that we have seen in the last, especially in the few quarters.
Yeah. No, so I mean, the way you evaluate any business is the same. So first of all, you're trying to assess, I mean, the three key pillars that we talked about, whether this is a large cap isotope and which bucket are you looking at. So one is the more long term, companies, good businesses, high quality businesses, which have a good, strong, long runway of growth. That's your first bucket. And then whether it's a turnaround or transformational opportunity, that's the second area that you're looking at. And within that, you obviously are looking at for companies which are leaders, have high governance, etc. As far as the PSUs are concerned, I think there is no specific restriction whether we want to have a PSU or not. I think it's more about the quality of the business, what are the long-term growth drivers, whether the company is able to make consistent return on invested capital, what is the quality of the management, and therefore does that management enable the business to, make high returns on capital and are able to share it with the minority shareholders. I think the same metrics that you would use for any business, I think you'll also use for PSUs. And dividend yield is one metric of valuation that one could use, which is sort of, you can use a lot of metrics. So internally we use relative valuations, we do use long-term DCFs, etc., to arrive at what is the right value. So I think it's not like PSUs is a no-go, but you do evaluate each business on their long-term merits when you're looking at companies. As far as I think real estate is concerned, we do have some exposure in real estate, more sort of Bangalore-based real estate, where we believe and affordability over a period of time has improved, and we do believe there could be some, at least short to medium term, where you would see real estate company is doing well. One, because we are seeing some amount of revival in real estate cycle, and secondly, we have seen that some of the organized players are taking market share away from some of the smaller unorganized players, purely because their ability to attract capital at low cost is much better as compared to maybe some of the unorganized developers.
Sure. Thanks, Ankit, for that.
So just to add,
Sure.
just one point on the dividend yield. Look, you can screen for companies which have high dividend yield. Doesn't matter whether they are PSU or non-PSU. But I think there are 2-3, important things that you need to do after that. One, is the dividend sustainable? Because if it's not sustainable, then investing on the basis of 1 year's dividend yield is not a good idea. So that's point number one. Second, a reasonable dividend yield in a company which is consistently able to generate a return on capital which is higher than cost of capital is more attractive than a high dividend yield in a company which is not able to generate a high return on capital compared to cost. Because eventually, if your return on capital is not higher than cost of capital, it will compromise your ability to pay dividends. So, those are the two filters that I would add on saying, sure, you should look at high dividend yield. Again, irrelevant, PSU, private, doesn't matter. But you need to run these other two tests before you determine that this is actually attractive.
Sure. Thanks, Vetri, for that. In the interest of time, one last question. Perhaps this is a question to you, and post which you can wrap the session as well. So, what is your advice for investors who are scared about volatility in the global markets and also continued geopolitical tensions? So, how could one protect the portfolio gains in a volatile market or a falling market?
Sure. Look, all I'm going to say is that the markets by definition are volatile, right? If you're going to wait for all volatility to vanish, which means, the market is either pricing in no downside risk or there is no volatility, you most probably will also end up sacrificing return, or you could end up with a very poor return outcome because everything which is there to worry about is already, is non-existent, and therefore valuations are already elevated. So I would actually say that volatility is an investor's best friend. Never wish for a market which is low volatility. If it is low volatility, I assure you it will eventually convert into low return. I'm talking at a market level. This does not apply at a stock level, right? At a stock level, you need to think about this differently. But as an aggregate, a volatile market is one that creates opportunity. So that is point number one. As an investor, volatility is your friend. Having said that, there are some people who could be exceptional in terms of their skill set. They can use volatility to buy markets as an asset class when they're very cheap, reduce allocations when valuations are very rich, but not everybody may have that unique talent. If you don't, then the best way to ensure that volatility remains your friend is to stagger your investments, because what you're saying, it doesn't matter to me. I will just use all these ups and downs to continuously buy the same level of allocation in the markets. And therefore, over time, I will make sure that I have averaged out my investment purchase. And, therefore, I am reducing my risk. So both of these are strategies you can use. Use allocation, use valuations to determine how you will enter the market, but you have to be exceptionally skilled to be able to do that. If you can't do that, there is a simple option. Just stick with the, SIP or dollar cost averaging, as it is called, because at low prices, you're getting more units. At high prices, you're getting low units, lesser number of units, and automatically, therefore, it's, starting to optimize your returns. It's not a maximizing function. It's an optimizing function. But anyway, on that note, that volatility is actually an investor's best friend. Let me pause over there and just say that thank you very much for all your questions today. We enjoy bringing this monthly webinar to you, both me along with, of course, this time Ankit, as well as my other colleagues, fund managers who've been on this webinar. And thanks to Niranjan as well for putting together the slides, the data, and compiling the questions. And do send us your questions, because your questions help us stay on our feet. Your questions help us address the presentation itself to sort of answer some of the thoughts and the frequently asked questions which are there or which are getting discussed. And that's really the purpose of doing this monthly webinar. Of course, The webinar is also eventually hosted on YouTube, so you can watch a recording of it if you missed it, or if there are pieces you want to sort of go back to and listen again. So many ways to consume the content. It's our job to stay engaged with investors, hold your hand through all that volatility, and that is what we would continue to like to do. So thank you once again for joining us this evening, and we look forward to connecting with you again in June. Thanks, Ankit, and thank you, Niranjan, and thank you everybody who joined us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.